Hello viewers, welcome to my channel Rohan Finbus. I'm sure most of you would have been in the situation when you buy a stock, the stock starts going down, you hold it for some time anticipating that the stock will go up, but one fine day out of frustration you sell it off. The day you sell it off, from the next day it starts going up and you again get frustrated and you attribute this to either a bad luck or you call stock market as a gamble. Stock market to jua hai, but stock market is not gambling. It happens because you do not understand what trend the stock is in. You need to understand the price structure as well as underlying trend. Unless and until you understand the underlying trend, you will not be able to make money in the stock market, right? Remember, make friendship with the trend is your friend. As long as you make friendship with the trend, you will be able to make money in the stock market. Now we will see what is a trend, what makes the trend to get formed, and what different types of trends you will see in the market. We'll look at some examples to make you understand better. In simple words, trend is an overall direction in which the stock price moves in. You need to understand the current trend of the market to in order to predict the future trend or future movement. Most of the times you would have seen the prices of fruits as well as flowers going up when the festivals are around the corner. This happens because there is a huge demand for the product and the vendors know that there will be buyers who will be willing to buy these fruits as well as flowers, and that's the reason they keep the prices high. But as soon as the festival season gets over, the prices start normalizing it. You can apply a similar analogy in the stock market. For instance, if company's financial performance is in a really good shape, that is, the company makes profits quarter on quarter, it improves its financials in terms of, let's say, the overall debt getting reduced or price to earning ratio getting improved or the earnings per share getting improved, buyers are interested to buy such stocks, right? Buyers make an informed decision to buy the stock when they feel that it has reached a fair value or at an intrinsic value. Now, all these concepts are covered in fundamental analysis. It's a different topic altogether, but just so you know that the trend gets formed when the investors feel that the stock is fairly priced or maybe overpriced. When they feel it is fairly priced, they start accumulating it. Once they accumulate it, these prices start moving up. And if they feel it is an overpriced stock, the stock gets into a distribution phase and it goes down. At times, you will see that the stock is neither moving up nor moving down. That phase is called as a sideways phase or a consolidation phase, in which the prices take a breather after, let's say, a sustained up move or a sustained down move. We'll look at the three different types of trends with some examples. First, let's look at how the upward trend gets formed. Now, let's look at what constitutes an upward trend. You can see here that the stock price moves up, the demand rises up, and it comes down. Again, the demand comes in, the stock moves up, the demand rises down, it moves down, it moves up. So this is an upward trend. In an upward trend, the stock generally makes higher high and higher lows. Now, this is the low. The next low that gets formed is higher than the previous low, hence we call it as a higher low. Then it makes the higher high because this higher high is more than the previous high. This low is higher than the previous low, then it becomes a higher low and the series continues. This constitutes an upward trend. Now, what constitutes a downward trend? The stock goes down, it bounces back but again faces a supply. It goes down further, tries to bounce back but again faces a supply, goes down, again bounces back but faces a supply and goes down. This constitutes a downtrend in which the stock makes a series of lower highs and lower lows. So for instance, this is the high. The next high that the stock made is this, which is the lower high. And it makes a lower low, which is lower than the previous low. It again makes a lower high and lower low combination. And the series continues. So this constitutes the downward move. Now what constitutes the sideways move? So in a sideways move, what happens is that the stock generally trades in a range. It neither goes up nor goes down. So this particular zone is known as a range bound movement in which the stock neither goes up nor goes down. Now, how one can make an entry into a stock once a trend gets identified. So for instance, if you want to buy a stock in which there is an uptrend, what you can do is that you can mark these higher highs. Once the stock breaches this higher high over here, you can take an entry and you can keep the stop loss at this previous higher low. So this can be your stop loss and this becomes your entry price, right? This is one way of entering into a stock which is in an uptrend. Now, how can you make money out of the stock which is in a downtrend? So first of all, if you observe this kind of pattern on the chart, you should never buy that stock. You should refrain from buying the stock which is there in the downtrend unless and until the trend reverses. In such stocks wherein there is a downtrend, what you can do is that you can take a short entry wherein you can sell the stock when this low gets breached. This is the price point wherein you can enter into the stock, you can sell it, and you can keep the stop loss as the previous lower high, and you can continue to ride this trend. In a sideways market, you can make an entry in a long position if the stock comes over here and touches the lower end of the range, and you can sell the stock when it touches the higher end of the range. So you can make multiple entries and multiple exits when the stock reaches either the lower end of the range or the higher side of the range. There are times you will see that the demand zones and the supply zones are not linear in nature. At times what happens is the stock moves in a channel. So if you look at the lower peaks, if we join them, this becomes the support line. And when we join the upper peaks, it forms a trend line resistance. We can buy when the stock comes over here, and we can sell when the stock touches the resistance point. Similarly, you will also find a stock moving down in a parallel channel, the top of which it makes the resistance, and then at the bottom it forms a support. So you can buy whenever the stock comes near the support trend line, and you can sell whenever the stock comes near the resistance trend line. This is how you can make money in a downtrend. Is it simple as it appears to be? Of course not. There are some other elements of price action that needs to be combined with this theory, and a decision needs to be arrived at whether to buy the stock or sell the stock. But the essential part of this is one should never buy a stock which is currently in a downtrend unless and until you see a trend reversal. You may get stuck in the stock if the stock is in a downtrend and you take an entry into that, you get frustrated, then the price goes down and one fine day you exit. Post that it starts going up. That's the reason it is important for us to look at the trend before we make a purchase decision. Now, this trend is different for an intraday player who looks at only the price movement within a day, or a short term trader who looks at the price movement for, let's say, next 1 month or maybe for few months from now, and a long term investor who has a view of at least 1 or 2 years. Hence, we need to look at multiple time frames based on what time frame we have in our mind. Look at some quick examples and try to understand how we can identify the trends. I opened up a weekly chart of GNFC and you can clearly see that the stock is in an uptrend since March 2020. Now, how I can say that the stock is in an uptrend? Let's try to figure it out based on the trend lines. We can see that the stock is making higher highs and higher lows, right? The series of higher highs and higher lows continues and the stock keeps moving up. And this is the feature of an uptrend, right? This is an uptrend. So we call this as an uptrend. Before this uptrend got formed, the stock was in a downtrend from October 2017. We can draw a similar line when we can see that the stock is continuously making lower highs and lower low combination. Right? So this constitutes a downtrend. After a sustained up move, we can see that the stock has taken a breather and it is currently trading in a range. So this is a perfect example of a sideways move where the stock is neither going up nor going down. And we can clearly see that there's not much selling pressure over here. Once the selling pressure is seen, probably we can call this phase as a distribution phase wherein the investors offloaded their stocks. However, as of now, we can keep considering this particular movement as a sideways movement or a consolidation phase after a quick up move. Let's look at an example of ITC. This stock was talk of the town during COVID. You can see over here that the stock failed down till 112 level, but post that the stock is in a continuous uptrend. We can clearly see that the stock is making a series of higher highs and higher lows, and this trend is still ongoing. Right? Now you may ask me, when do I enter into this trend? The simple answer is you mark the higher highs. Once the higher highs gets broken, you can make an entry into the stock by keeping a stop loss at the previous higher lows. If you make an entry over here, then your stop loss becomes 145. So if you had entered into this trend once the previous high got broken, you could have made a lot of money and you could have stayed in the trend till this series of higher highs and higher lows are intact. Here is another example of a stock which is in an uptrend. It's an Elecon Engineering weekly chart and I have marked the higher highs and higher lows. One can enter into the stock when the highs marked in red line are breached by keeping a stop loss at the lows marked in green. Now let's look at an example of uptrend, downtrend and sideways trend in a single stock. I have considered tin plate weekly chart in which you can clearly see that there was a downtrend in tin plate and the downtrend continued till the March 2020 wherein it made a low, and post that a trend reversal happened and the stock went into an uptrend. You could have avoided buying this stock when it was in downtrend, and you could have made an entry when the stock was in an uptrend. And now currently the stock is in a sideways trend. It has taken a breather after a sustained up move. I hope this video would enable you to make an informed decision of entering into a stock. You should never enter into a stock which is in a downtrend until and unless you see a clear trend reversal. You could avoid getting into a trap of buying a stock which is in a downtrend. While this is only a basic level of information, but it would definitely help you avoid making a wrong entry. Now, with this, you can make a good decision of entering into a stock at a right price level. However, you can also learn few more price action elements such as moving averages, chart patterns, candlestick patterns, and some of the key indicators to increase the odds of winning. I'll cover them in my upcoming videos. Thanks for watching.